How does a mortgage work in simple terms? When you get a mortgage, your lender gives you a set amount of money to buy the home. You agree to pay back your loan with interest over a period of several years. You don't fully own the home until the mortgage is paid off. The interest rate is determined by two things: current market rates and the level of risk the lender takes to lend you money. You can't control current market rates, but you can have some control over how the lender views you as a borrower. The higher your credit score and the fewer red flags you have on your credit report, the more you look like a responsible lender. In the same sense, the lower your DTI, the more money you'll have available to make your mortgage payment. These all show the lender you are less of a risk, which will benefit you by lowering your interest rate. The amount of money you can borrow will depend on what you can reasonably afford and, most importantly, the fair market value of the home, determined through an appraisal. This is important because the lender cannot lend an amount higher than the appraised value of the home. So you might think to yourself, what is the difference between mortgage and loan? A loan is the sum of money borrowed from a financial institution to meet various monetary requirements. Mortgage is the function of keeping an immovable property as collateral with a lender to avail the loan. So after that you might question yourself, can you sell a house with a mortgage, or can I sell my house before paying off the mortgage? Yes, you can sell your house before paying off your mortgage. Mortgages range anywhere from 10 to 30 years, so most homes sold in the US aren't fully paid off. Focus on a mortgage that is affordable for you given your other priorities, not on how much you qualify for. Lenders will tell you how much you are qualified to borrow, that is, how much they are willing to lend you. Several online calculators will compare your income and debts and come up with similar answers. But how much you could borrow is very different from how much you can afford to repay without stretching your budget for other important items too thin. Lenders do not take into account all your family and financial circumstances. To know how much you can afford to repay, you'll need to take a hard look at your family's income, expenses and savings priorities to see what fits comfortably within your budget. Don't forget other costs when coming up with your ideal payment. Costs such as homeowners insurance, property taxes, and private mortgage insurance are typically added to your monthly mortgage payment, so be sure to include these costs when calculating how much you can afford. You can get estimates from your local tax assessor, insurance agent and lender. Knowing how much you can comfortably pay each month will also help you estimate a reasonable price range for your new home.